This UAE property manager went from managing 25 to 2,500 units in 9 years. Incredible, right? Hello, everyone. Welcome back to another new episode of the Vacation Rental Scale Up podcast. I'm your host, Thibault Masson, and today I'm really excited to share some powerful insights from the recent Scale Show Barcelona. Scale Show Barcelona, a major industry event for rental professionals, was special for Rental Scale Up this year. We hosted the Knowledge Stage, featuring only property managers sharing real world strategies. A standout session, Diversity is the Key: How to Go from 25 to 2,500 Units, by Mahush Alam, founder of One Perfect Stay, drew a full house. Now, if you're not familiar with One Perfect Stay, let me fill you in. Founded in 2016, One Perfect Stay has become a major player in the UAE's short-term rental market, particularly in Dubai. They manage over 200 curated homes, and these aren't just any homes. They're located in prime spots around Dubai, and they're meticulously selected for quality, location, and ambience. But what really sets them apart is their commitment to what I like to call digital hospitality. They've made luxury feel accessible, and that's no small feat in a market as competitive as Dubai. The numbers they're putting up are impressive: 400 rooms under management, a staggering 200% annual growth rate, $3 million in gross annual sales, $100 million in assets under management, and an 85% occupancy rate. If that doesn't get your attention, I don't know what will. So, what's the secret sauce behind One Perfect Stay's success? According to Mahwoush Alam, one of the key factors is diversification, and that's exactly what we're going to dive into today. I'm going to break down what diversification means in the context of short-term rentals and how it can benefit your business. And of course, I'll sprinkle in some real-world examples to bring these concepts to life. Stay ahead in the short-term rental industry with our weekly insights. Don't forget to hit follow and subscribe so you never miss an update. Let's start with the basics. When we talk about diversification in the short-term rental industry, we're talking about expanding your property portfolio and revenue streams across various types of assets, locations, and business models. The goal here is simple: spread your risk and increase your potential returns. Imagine this: you're heavily invested in just one type of property, say beachfront villas. Now, what happens if there's a sudden drop in tourism in that area? You're left vulnerable. But if you've diversified and also own urban apartments or mountain cabins, you've got a safety net. That's the beauty of diversification. It helps you weather the storms. Now, there are several ways to approach diversification in our industry, and each method comes with its own set of advantages and challenges. Let's dig into a few of these methods. First up is rental arbitrage. This strategy involves leasing properties from landlords and then subleasing them on platforms like Airbnb or Booking.com. You might be wondering, why go this route? Well, rental arbitrage allows you to expand your portfolio without the huge upfront costs associated with buying properties. If you're interested in learning more about rental arbitrage or want a dedicated episode on any related topic, drop us a comment. We're here to cover what matters most to you. Let me give you an example of rental arbitrage. Suppose you lease a property for $2,000 a month. If you can rent it out on Airbnb for $150 a night and you manage to book it for 20 nights a month, you're looking at $3,000 in revenue. After covering your lease, you've got a nice profit margin, and that's without owning the property. It's important to note that this is, of course, an oversimplification. There are other costs associated with short-term rentals, STRs, beyond just the lease, such as maintenance, utilities, insurance, property management fees, and local taxes. Another approach is the master lease model. This is similar to rental arbitrage but on a larger scale. In the master lease model, you lease multiple properties under a single agreement. You're responsible for managing and marketing these units, and you keep the profits after paying the lease. This model offers more stability because you're locked into a long-term lease, which can be particularly advantageous in markets with high volatility. Now, let's talk about revenue sharing. This model involves partnering with property owners, where rental income is divided based on a predetermined percentage. As the property manager, you handle all the operations, everything from marketing to guest communication to maintenance, and in return, you get a share of the revenue. This model is great if you want to expand your portfolio without the upfront costs of purchasing or leasing properties. For instance, you might strike a deal where you keep 30% of the revenue while the property owner gets 70%. It's a win-win because the owner benefits from your expertise and you get to grow your business without a significant initial investment. While revenue sharing and rental arbitration may seem similar at first glance, both allowing you to grow your business without purchasing property. They are distinct models with key differences. In revenue sharing, the risk is shared between you and the property owner, as both your incomes are tied to the property's performance. In rental arbitration, you bear most of the risk, as you need to cover the lease and other expenses, regardless of the property's performance. Revenue sharing typically involves lower upfront costs since you're not paying for a lease, but your income is also proportionally smaller as it's a percentage of the revenue. Rental arbitration might involve higher initial and ongoing costs, but you have the potential for higher profits since you keep all the revenue after covering expenses. In revenue sharing, the property owner remains actively involved in the financial outcomes, sharing both risks and rewards. In rental arbitration, the owner is generally more passive, receiving a fixed rent regardless of the property's rental performance. So while both models offer a way to grow your short-term rental business without purchasing property, they differ significantly in terms of risk, financial structure, and owner involvement. So diversification sounds great, right? But like everything, it's not without its challenges. Let's explore both the pros and the cons. One of the biggest advantages of diversification is risk mitigation. By spreading your investments across different assets, you're not putting all your eggs in one basket. For example, if you own both urban apartments and beach houses, a downturn in tourism might hit your beach properties hard, but your urban rentals could still perform well. This balance helps to cushion your overall portfolio from localized economic downturns or seasonal fluctuations. Another benefit is capital preservation. By investing in various asset types, you reduce your exposure to the failure of any single asset. For example, owning a mix of short-term vacation rentals and long-term residential leases ensures that if the demand for short-term rentals drops, the steady income from your long-term leases can keep you financially stable. Then there's the potential for steady returns. A diversified portfolio often experiences smoother returns because the volatility of one investment can be offset by the stability of another. For instance, while vacation rentals might have seasonal peaks and troughs, urban rental properties may provide more consistent income throughout the year. This steady cash flow is crucial for maintaining the health of your business. Diversification also opens up growth opportunities. By spreading your investments across different markets, you can capture growth potential in various conditions. For example, investing in emerging markets like Riyadh, where the hospitality sector is expanding, alongside established markets like Rome or Barcelona, positions your portfolio to benefit from growth in both new and mature markets. This strategy allows you to tap into the growth potential of newer markets while still benefiting from the stability of more established ones. So, diversification also applies to operating in diverse markets and not just adding diverse property types to your portfolio. However, there are some downsides to consider. One potential drawback is the possibility of diluted returns. While spreading your investments can mitigate risks, it may also mean missing out on high returns from a single high performing investment. For instance, if a particular city experiences a real estate boom and you've only allocated a small portion of your portfolio there, your overall returns might be lower than if you had concentrated more heavily in that booming market. Managing a diversified portfolio also increases complexity and requires more time and resources. If you own properties in different countries, for example, you'll need to understand and comply with various local regulations, tax laws, and market dynamics. This can be time consuming and requires a lot of expertise. It's not just about managing properties anymore, it's about managing complexity. There's also something called correlation risk. During times of market stress, assets that seemed unrelated might suddenly start moving together, limiting the effectiveness of your diversification. For example, a global economic crisis affecting tourism could simultaneously impact your vacation rentals in multiple countries, reducing the benefits of having a diversified portfolio. So, while diversification can help mitigate some risks, it doesn't make your business immune to global events. And finally, there's the risk of over diversification. Yes, you heard that right. Too much diversification can actually be a bad thing. If you spread your investments too thin, you might face challenges in effectively managing and optimizing each property. This can lead to higher operational costs and diluted profits. Think of it like juggling. You can only keep so many balls in the air before things start to drop. All in all, One Perfect Stay's insights at Scale Show Barcelona highlight the importance of diversification and strategic expansion. By leveraging hybrid models, maintaining operational flexibility, and focusing on delivering top notch guest experiences, property managers can effectively scale their businesses and capitalize on the booming short term rental market. And that brings us to the end of today's episode. I hope you found these insights as fascinating and useful as I did. Remember, diversification isn't just a buzzword, it's a powerful strategy that can help protect your business from risk while also unlocking new growth opportunities. Whether you're just starting with a few properties or you're looking to scale up to a large portfolio, the principles we've discussed today can be a game changer. As always, thank you for tuning in to the Vacation Rental Scale Up podcast. If you enjoyed this episode, be sure to subscribe so you don't miss out on future insights and strategies to help you grow your rental business. And if you have any questions or want to share your own experiences with diversification, feel free to reach out. I'd love to hear from you. Until next time, take care